Good morning, guys. It is actually pretty dang early. It's 5:30 in the morning Pacific, 7:30 where I'm at. I'm Central Time at the moment. And I thought I'd get this out early because I've got just stuff hammering all damn day long. I have zero moments available at all. So I was up at my standard 4:30, but Central Time, right? So 2:30 my standard time of Pacific. Had to get into the gym in the hotel and get some time in, and then get caught up on what's going on in the market. And it's really kind of hard. What is there to be caught up on, really, right? It's quite the mess out there as far as what we're seeing with respect to the reaction to the inflation numbers. And as I said last time that I put something out, I don't understand the reaction. So we're getting into the charts right here. The chart's going to look a little bit different today, but what I mean by don't understand the reaction still is what in the hell went down from April to May to where we are today in June that would even remotely make anybody believe that the inflation would get better. I hadn't seen anything that got better in price, not fuel, not energy, not food, not anything, just nothing, right? Interest rates going up, cost of housing's going up, the rent's going up, nothing went down. So why would the market have been so surprised with the reading of 8.6% inflation? I mean, hell, I'm surprised it wasn't 9. So I'm surprised that's where my surprise is. Why isn't people like, oh, shit, it's lower than what we thought? For some reason they thought, and here's the only thing I can believe, is that there's been enough bullshit coming out of the mouths of the people in DC to make everybody think that things are better than what they really are. And they're making people believe it. And people were listening. I don't understand it. I honestly do not freaking understand it. So I'm not going to berate that anymore. So let's look at the charts of what's going on. I had the dang thing up, so I might as well talk about it. So what I'm showing here, this line is referencing the 10-year treasury. All right. So a lot of people look at the 10-year as, oh, what's going on in interest rates? The 10-year is just a long-term bond, right? That's a U.S. Treasury note. You're giving the money to the U.S. government. They're using it and paying you a flat rate of return, and then you're going to get it back after 10 years. That's what it is, right? So for some reason, people use that as a barometer of what's going on in interest rate. It's just another long-term instrument, guys. Now, this is your mortgage-backed security. I'm looking at the 4.5, right? Because what we've been looking at. And if you look at this, we were on this trend line, right? We had this established, very, very, very well established floor that was giving us some protection against downside. Then we had that reading, right? And look what happened. Bam, opens up with this big gap and a hard drop. Another bam, open up with a big gap and a hard drop. We almost touched the bottom of this, almost touched the bottom of this trend line. Actually, I think you could even probably argue that I can bring that trend line up a little bit to right here. Yeah, that's about where it was, where everything's bouncing off that line. And I could bring this line down a little bit more right in here, and pretty much you're in it. I mean, you're right there in the, I gotta readjust it just a tad here. Yep. And look at, we hit it. I mean, if you adjust it right where everything hit and bounced off of it, we literally hit that line. So it hit that particular trend, came up off of it. I hope that that's a protected piece, but again, it's a slide. I don't know that it is anything to protect, right? If you bounce, if you're running, right, and you jump onto a slide and you bounce, right, you may come up, but you're going to bounce, go back down onto the slide. There's a point where the slide ends and you level out. I thought we were there. I thought we were at that one point where we had everything was going to go sideways. Looks like the market was not ready for a reading such as what we got, which again, I can't speak anything towards it. So the only thing that I can see that's coming up that might give us a little bit of reprieve. So the Fed is meeting tomorrow, right? So this is Tuesday, the 14th. They're meeting tomorrow, the 15th, 11 a.m. Eastern time. And they're going to talk about interest rates. Now, there is, of course, Fed futures are saying they're going to raise them about 0.75%. It could be 1%. We don't know. Don't freak out about that. If they raise, the harder they raise, the more it is anticipated to help inflation. Therefore, it could impact us to the extent of finding another floor. I don't know for certain, but Federal Reserve interest rate raise, right? Raising the federal fund rate is supposed to help quell inflation. Right now, we saw what happened when inflation was worse than what they thought, and is slightly worse, right? we saw the effect that had on our long-term bond markets. Therefore, the interest rates went up. So if the Fed raises rates to help kind of stifle inflation, then that should be beneficial for long-term bonds, should benefit those things. So hopefully we get some stability again back for a little while. Can't say where it's going to go. Right now, we just want to protect anybody away from any more of that slide. And hopefully we get a bounce. But again, I don't know. We don't know. We'll see what happens tomorrow. But I just wanted to get you that information because there's nothing else going on today other than just letting you know what's happening in the bond market. And we'll see. I'll get you back with you on Friday. If there's anything crazy, I'll get you some more data to work off of. But right now, there's really nothing crazy for us to worry about other than the craziness we've already experienced. So thanks, guys, and I will get back with you on Friday.